You may learn about investing and how to make the best financial decisions for your life on Investor Facts. Make sure you click the subscription button and enable the notification bell if you haven't already. Share, like, and comment. Well, the situation has gotten significantly worse. The S&P 500 recently returned to its June lows and unexpected broke below them, indicating that individual investors have completely capitulated over the last 2 trading weeks, as we recently learned. Therefore, I'm confident that this signifies that the stock market will continue to decline as panic individual investors liquidate every stake they have in the Robinhood and TD Ameritrade accounts. As we all know, the stock market is seldom so straightforward. So the news of capitulation of ordinary investors is actually very positive. And in this video, I specifically want to talk about that. In order to get things started, I want to specifically address a tweet that Ray Dalio sent out recently, in which he abruptly changed his mind and said the money is actually no longer trash. The simple justification for this is that you get practically no return on your cash when it's just sitting in the bank, and instead, high inflation actually eats up the value of your dollar. This is why Ray Dalio, historically, has always been a buy and dip kind of investor and has always positioned himself away from just holding straight cash. So, you're much better off investing it in the stock market or in bonds, where you can get a 5 to 10% return. However, when he comes out and says that his opinion for the past 20 to 30 years has suddenly changed in a matter of months, it really just goes to show that we're living through a historic period and we might be close to the stock market's bottom or capitulation phase. The reason is really straightforward. Once pessimism reaches its pinnacle, no one else will be willing to buy your stocks. This phenomenon almost always occurs when the news is at its worst and optimism is at its lowest point. Given that the S&P 500 has historically returned fantastically after declining by 20% from the record highs, even if it has taken longer than a year on occasions, it is safe to predict that this is when investors will most likely to see the greatest gains. This particular illustration, in my opinion, really effectively summarizes my position. You can observe this when stocks are high at all-time highs, when optimism is at its height, and when both institutional and ordinary investors exhibit little to no anxiety. Then there's just no way you can make money, because in that type of situation, where everyone is bullish and there's no longer any buyer, the risk-reward ratio is shattered. In that kind of environment, there is more potential for downside than potential for upside. But when the equities are declining, that is when regular investors come out and declare that everything is a hoax. The primacy bias in their minds tells them that the market will crash to zero. But the truth is, these individuals may have purchased equities at all-time highs before selling them for a loss. The only reason this chart exists is because they currently want prices to drop even further so that other people also lose money. The psychology of the market and retail investor is what creates and destroys investor riches. The bottom will be very close to us when most retail investors believe we are in complacency or anxious phase because, as we all know, retail investors always lose money over the long run due to their own psychological flaws. Retail investors are actually shorting the market wildly right now, and bets against the S&P 500 in particular are at peak that we didn't even see in 08 or 2020. A major factor in this is that early millennials and Generation Z individuals are experiencing their first bear market in their adult lives. That, in my opinion, demonstrates perfectly why there is such market volatility due to the ease with which false information are feared can spread. Because, let's face it, social media has never been so widely used during a bear market. Over the previous 10 years and the previous decades, we do not witness anything comparable. the dread and pessimism inside the average retail investor's thinking tends to get amplified on social media as a result of the really rapid adoption of consumer gadgets, which increase volatility and panic selling. It results in social media sharing of charts like these that tend to frighten many people while also fooling many others who recognize that the current scenario is entirely and greatly different from all of the other situations documented on this graphic. By far, the greatest reason why I believe retail investors actually lose money over the long term is because they decide to exit their position at a realized loss because they believe that they made a mistake because their stock declined in value immediately after they bought them. As you can see, even if you buy over the next 6 months to 1 year, you may still experience significant short-term declines in the S&P 500. Even so, the returns will still be far more than they would be if you were simply not sold. The problem is that, unlike real estate, which most Americans own, you receive a price for your investment every single second on the stock market, which causes certain people with high levels of anxiety to utterly incompetent investors and to worry about their investment constantly. Overanalyzing always results in bad decisions, which is obviously the main reason why many retail investors fail, but I'm sure all of you already know that. Therefore, why am I discussing this on my own YouTube channel right now? Well, because I'm here to assist the typical retail investor in strengthening their belief in their own businesses and avoiding being caught up in all fear and blister that has cost so many of the millions of dollars over the past 10 years. The biggest misconception I'm hearing right now about the market is that you shouldn't oppose the Fed and that the market will continue to decline unless the Fed changes its stance. After reading tweets like these, I'm compelled to speak out about the tremendous drama surrounding the highly exaggerated "Don't Fight the Fed" storyline that is being shown on social media. First off, as you can see from this chart right here, interest rates have always increased even when the stock market increased, proving that there is no connection whatsoever between what happens to the interest rates and how equity value will behave. Second, as you can see from the graphic, the major takeaway is that the bottoms of the prior 6 bear markets didn't materialize until the Fed started intervening. As you can see, that is undoubtedly true, but investors are totally missing the point. The Fed, those cells have been the root of this bear market in the first place. This graph shows us each and every bear market was brought on by outside factors, either the Great Recession or the 2020 pandemic, the abolition of the gold standard in the 1980s, or the tech bubble. Clearly, since the Fed is currently letting us know exactly what they are considering when making their policy decision, inflation, of course, we are currently experiencing a situation that is entirely different from every single one of these time frames. So yes, it is true that the Fed steps in to save the market whenever there is a crisis. But you need that in a sound economic system because otherwise, the market as a whole will crash and the US economy will lose stability. In this instance, the US economy has been stable and prosperous for the previous 2 years that it has actually triggered inflation. Since the Fed is deliberately intervening to bring it down, this bear market is essentially manufactured. For the benefit of those in the back, allow me to reiterate that this bear market is being induced artificially to lower inflation. Therefore, you should pay attention to the inflation indicator if you truly want to play the market by purchasing at the bottom when the Fed pivots. The leading indicator of inflation are already showing us that they are declining. As I've repeatedly stated over the past month, this means that Fed may eventually start easing interest rate hikes, which would immediately cause a significant stock market rally because the market always looks ahead 6 months. It will concentrate on potential future events rather than what is happening right now. As you can see, the Fed has already drastically tightened its belt and is far along with its quantitative easing program. The fact that QT indicates that the stock market will continue to decline is yet another thing that many people erroneously believe. Any macroeconomist will tell you that is simply not how it operates though. The balance sheet has two sides, assets and liabilities. QE is essentially when the balance sheet is growing, and QT is just when it's contracting. The Fed is selling assets in this instance on the QT side and covering them with liabilities, so their balance sheets won't actually change. Overall, as you can see over time, the Fed's balance sheet always increases as a result of national economic expansion and dollar demand. As you can see, a consequence of raising interest rates is quantitative tightening, which has already demonstrated its ability to reduce inflation. As a result, the Fed has no real motive to sell all of its junk bonds, MBS, and obviously very low-grade bonds. Contrary to popular belief, no. Because these bonds are often given to startups and early-stage businesses. Selling them does not signal the impending collapse of the economy. In the grand scheme of things, those businesses essentially have no impact on the economy. Apple, Microsoft, Amazon, and Tesla are the only firms not issuing trash bonds or mortgage-backed securities that are literally driving the S&P 500. Deleveraging the market and bringing the credit cycle down from its peak are the true goals of quantitative easing. Historically, purchasing the drop has always paid well because, as we all know, credit cycle declines are healthy components of a long-term sustainable economy. Guys, understand that those are just my opinion and not financial advice. Thanks for watching the entire clip. If you like it, kindly let us know by hitting the like and subscribe buttons. Also, don't forget to enable the notification bell so you can be the first to know when we post a new video. In the following video, I'll see you. Goodbye.